If you've got multiple streams of income, be it 2 streams or more, there's no doubt you will want to know how the tax deductions work for you in a given tax year. After all, you work hard for your incomes, and the last thing you want to do is allow the taxman to take more than an optimal and fair share of your income simply because you're not in the know. In this video, we will cover what exactly do we mean by multiple streams of income, what are the most common income streams in my experience here in the UK, and finally, how does the income tax regime work when you have multiple income streams with a numerical worked example. Before I get into today's video, be sure to visit our Accounting and Tax Academy membership area where you can get access to exclusive in-depth courses, templates and calculators that will help you forecast and predict your tax and national insurance liability for the tax year ahead. There are perhaps 2 methods you can earn incomes from, that is actively or passively. Active income is essentially an exchange of your time in return for a wage, salary or fee. It is the most popular way of earning an income, especially through PAYE. That is pay-as-you-earn employment here in the UK at least. Passive income, for want of a better phrase, is what you earn whilst you sleep. You don't necessarily need to exchange your time for this type of income, although it still probably needs some effort in setting up and monitoring. Multiple income streams can be generated in a number of ways, and here in the UK, the most common types of income generated in my experience is as follows. Income from PAYE employment, income as a self-employed freelancer, as a self-employed tradesperson like an electrician or plumber for example, income as a limited company or umbrella company contractor by way of dividends in the main. Income from interest on savings, dividend income from investments in shares and other types of investment income, rental income from property, and finally pensions income. Note that in this video, the focus is on taxable income subject to Income Tax Act of 2003, 2005 and 2007, and not money generated from an increase in wealth. Well, what do I mean by this? Well, for example, if you bought a property, developed it and sold it for, let's say, a profit of £100,000, this is taxable, yes, but it is classified as a capital gain, not an income. The same goes for selling shares for a profit, trading income, or even selling a business. Traditionally, PAYE employment income, self-employment income, and property rental income were the most common types of income earned by UK tax residents. But a lot has changed in the last decade or so. Now, income from e-commerce trading, YouTube AdSense, affiliate deals, blog writing, and other digital and tech-based gigs have become very popular. And all these are now being done as side hustles. That is in addition to your employment or self-employment bread and butter income. But by far the most common combinations of income, or shall I say multiple streams of income, again, in my experience, is as follows. Employment PAYE income and property rental income, self-employment freelancer or limited company contractor income and property rental income, and finally employment PAYE income and e-commerce trading income. Now, these are just 3 different combinations we have measured through our own client services, but these are by no means exhaustive. Let me know in the comments below what combinations of income you are earning at present. It's certainly not a walk in the park generating and maintaining multiple streams of income and consistently. However, once you are at this point, you will certainly want to be smart about how much all of this income you get to keep as your own disposable income and how much ultimately the taxman takes. So follow this next section carefully, as here is how all your different streams of income are taxed. This diagram on screen illustrates the order in which income is taxed. The first type of income is called non-savings income. That is income from your employment PAYE, self-employment, rental income, and pensions in the main. The next section is interest income from savings that are not part of a tax shield like an ISA. And finally, the top size of income is dividend income. Let's call this our income tax scaleometer. For a reminder of the current income tax bands, rates and allowances, download our comprehensive guide that we will be referring to. As always, this concept is best explained with an example. Meet Harry, a web designer and UX expert who is employed full-time on PAYE and earns £35,000 per year gross. That is before any tax or national insurance is deducted. Harry also has other or multiple sources of income as follows. He receives a taxable profit of £12,000 a year from property rental income. There are savings interest income of £2,500 per year. He also does some side hustles in his own time as a self-employed person and earns a taxable profit of about £10,000 a year from these. And finally, he has a 50% share in his wife's limited company and receives about £20,000 a year in dividends from this company. So let's take a look at Harry's tax calculation using the 2020 to 21 tax rates. The lower slice of his income is his PAYE employment income, that is £35,000, and then comes his self-employed income of £10,000 and then his property rental income of £12,000. Next is his savings income of £2,500 per year, and finally his dividend income of £20,000. All in all, his total gross income is £79,500 for the tax year. Harry gets a personal tax allowance of £12,500 for the year, deducted from the total gross income, leaving a taxable income of £67,000, as can be seen on the income tax scaleometer. Now, onto the tax calculation itself. You can clearly see that the calculation is computed in the three different sections, that is non-savings income, savings income, and finally dividend income. Why? Because each type of income has different income tax rates applicable. Firstly, the non-savings income consists of Harry's employment income, self-employed profits, and rental profits, all totaling £57,000. The personal allowance is allocated against this section of income, so that leaves a taxable amount of £44,500. And £37,500 of this falls into the basic income tax rate band, hence taxed at 20%. The remainder is taxed at 40% as it falls into the higher rate tax band. Because Harry's non-savings income has already breached the higher rate threshold, for his savings interest income, there is a tax-free allowance of £500 for higher rate taxpayers, and the rest of his £2,500 of interest savings income, that is £2,000, is taxed at the higher rate, which is 40%. And finally, when we get onto Harry's dividends, he receives a £2,000 dividend allowance, and the rest is taxed at the upper dividend rate of 32.5%, as he is now a higher rate taxpayer. There's also a small amount of Class 4 national insurance as a result of Harry's self-employed income. For the sake of simplicity, we are ignoring Class 1 employees' national insurance in this example. Now, to illustrate clearly how multiple streams of income can impact your tax bill, let's suppose Harry's PAYE income of £35,000 did not exist. Now, the total income received is £44,500, of which £22,000 is non-savings income, £2,500 savings income, and finally £20,000 is dividends income. Let's apply these numbers again and work out the tax on each section. All of a sudden, the tax bands and rates apply a change for each stream of income. For the savings interest income, the tax-free amount now increases to £1,000 from £500, as Harry's savings income now fall within the basic rate tax bands. The rest is taxed at the basic rate of income tax of 20%. Harry still gets a £2,000 dividend allowance, but the big difference is now the remaining £18,000 of dividends are taxed at 7.5%, the ordinary rate of dividend tax. The main takeaway for you with regards to multiple income streams and taxation is knowing what type of income gets taxed when and at what rate. Use the income tax scaleometer for non-savings, savings, and dividend income. And what's more, one of the things you can do to control your tax bill for the year is to control your total income where possible. In Harry's scenario, he could have asked his wife not to have paid him a dividend of £20,000 and perhaps defer the payment of this until the next tax year. And that it is the case for many limited company contractors, freelancers, and tradespeople. You can control your salary and dividend income and thus control to a certain extent your tax bill for the year.